overseas $10 billion US dollars. Am I still correct on that figure? 10 billion?
Yeah, you're right. Yeah.
What are you guys doing with that 10 billion? Where are you overweight?
So I think if you look across our regional funds, clearly there's an opportunity in markets like India, which have done well. ASEAN is coming back well after 7-8 years of underperformance, and I think China one is closing a bit of an underweight, which is there. The market's corrected, so there is value in some of these internet platforms over there. One is adding over there. The renewable space is something we've always liked in China, so one is adding to exposure over there.
Are you worried about stagflation or stagflation-like conditions? How are you looking to use this opportunity?
Honestly, not. We are not worried about stagflation, and why I say that is, look, if we see over the last 18 months for the top 30-40 percentile of population, you've seen incomes grow. Wealth effect has been positive, and it's these guys who matter from a consumption perspective. The consumer is just holding back because, look, SKUs are not available for different products they wanted to buy. Product prices have gone up, and with opening up, the money is being spent on consumer services, travel, etc. So give it 3 to 6 months. I think the demand for durables would pick up again. Some of the supply bottlenecks which happened because of COVID and higher quarantines in Asia should ease. So
I mean, but I guess looking forward, short term, is margin pressure likely going to show up in, especially non-materials, because that doesn't seem to be priced in completely yet?
Absolutely, absolutely. So I think margin pressure is going to be the most talked of thing for this quarter earnings.
Okay.
But what markets would look at is the revenue momentum. If companies have a strong revenue traction and they're showing the ability to pass on some of these higher RM costs, markets should be comfortable with that. See, look, these companies would not pass the entire cost in one quarter, but give it about 3 to 4 quarters with the resilient demand. I think good companies can easily pass some of this margin pressure to the consumer.
Is it still cyclicals? People tell us that cyclicals within the equity space as major exposure.
Yeah, so we continue to like kind of a cyclicals within the key markets, India, Vietnam, Korea, etc.
Okay.
These would be financial, these would be industrials, because look, a lot of these markets are coming out of kind of a 7-8 years downturn, underinvestment, etc. And in the early stage, though valuations may look expensive, but the revenue momentum takes care of it, and then you get an operating leverage which plays up.
You mentioned India. India's gone crazy. It's an absolutely nuts. I mean, on price, valuations are also cut at crazy levels. What do you do with that information? Because there's also oil.
So absolutely right. So I think this is a question we get from most investors, that look, India is at the highest premium it's ever been to the EM basket. Do you sell this market on every rise, or do you buy on dips? I think that is the critical question one has to kind of get clarity on. That is India a buy on dips market for next 4-5 years? And I think there's been a lot of changes which has happened and which makes it a buy on dip market from our perspective. And why I say that is, look, there's been no investment cycle for last 7-8 years in the country. We've got a government because of all these production incentive things boosting that. There's a huge pent-up demand which is coming through. All these IT services doing well creates a strong virtuous loop in terms of 30-40% salary hikes, etc. So should an oil shock comes, which looks like it would come in next 3-4 months, one would look to add exposure to India. Because
why hasn't it come? I'm curious. I mean, is there a trigger that is easily visible for India?
I think what's happened is somewhere currency is given away 3-4%. If you see over the last 30 days, rupees depreciated by 4-5%, and I think it's deliberately orchestrated by RBI because forex reserves are record high at 625 billion. So there is no reason for currency to weaken. But look, the central banks ahead of the tapering would like a currency which is attractive. So I think that's why currency is weakened. So from a US dollar perspective, there's already a 5% correction happened. So give it 10% in local equities and another 3-4% on currency, you have a 18% dollar correction by Feb-March, and I think that again makes India attractive.
Well, that brings up the other key issue is tapering. Then we have rate hikes possibly in the next 14 months. Are you guys hedged? How do you hedge the currency exposure for dollar investors?
So I think that's a tough thing because look, it's always expensive. 5-7% is the cost for hedging this. What you do is you play the global cyclicals who benefit from rupee depreciations. You play the IT companies. You play the materials whose products are priced in USD. So that's the only way you can hedge that exposure.
Now you're still underweight China. You talked a little bit about it, but you've reduced that underweight. What have you been buying?
Okay, so again, the premise for being underweight China was that, look, the problem in the world for last decade was China had overinvested, rest of the world had underinvested, and that's getting sorted now. The rest of the world is picking up in capex. China has to correct these excesses. So I think it's going to be a slow recovery, a fairly long drawn-out recovery. So what we are doing there is some of these internet platforms sold off excessively. So you look at space like food delivery, etc., where the headroom for growth is huge, and where the regulatory punitive actions would not be severe. So these are marginal costs which can be easily passed to the end consumer. So that's something which is attractive for us. Some of the reopening plays in tourism are attractive, It's a matter of time, next 6 months, where the market or the economy opens up. And then the renewables. I think clearly China has established a clear leadership in the renewable space, whether it's solar or EV.
That's crowded, though.
Yeah, but look, after 6-8 months of underperformance, I think valuations are a lot more palatable now. They're not cheap, but they're reasonable. They're reasonable here.